All right, the S&P got, and the Dow Jones for that matter, got new all-time highs today. Good bullish patterns on the market forecast charts for those indicators, suggesting we can be more bullish here in the short term. There are a few indicators though that are kind of dialing back the bullish sentiment in terms of like, hey, now we got new all-time highs. Let's get going here to the upside. So we're going to break that down in today, what those indicators are. There's a couple that really stand out that are kind of showing us patterns that you would not expect to see on a day we're getting all-time highs, at least on a day where we're getting like maybe a first all-time high that can lead to a run for a string of a bunch of them, right? Where you can kind of get going to the upside. In particular, there's a huge divergence in market volatility, different measures and indicators we look at to kind of measure the volatility in the S&P 500, the index itself, and then the options market volatility for the S&P 500 and what it's telling us. There are some big divergent patterns developing. We'll take a look at that. In fact, the correlation with volatility in the S&P is generally very negative, very strongly negative, not so strongly negative now. So we're going to break down what that means, what we can expect to see because of those divergences. We'll take a look at what's driving the price action in the past few days. Very good bullish, but a very narrow move. I'll explain kind of what I mean by that with the narrowness of this move and what that means. And then we'll take a look at a trade idea that's outside of that QQQ technology space that has been relatively bearish for a while now and is showing a pretty bearish, a little bit of a breakout pattern to the downside. So we'll take a look at trading that. So let's go ahead and get started. Today is Wednesday, October the 9th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. There's really been no reason to get out of some of our recent trades. They've mostly been doing pretty well. Let's come down to the bottom, click the heart. It opens up this tab, hit that like button there. Same thing here, click this thumbs up icon. It opens up this tab. Scroll down, hit that like button on today's Market Outlook video. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another update today, a new all-time high today, closing nearly at 5,800. It's a few points off of 5,800 there, and we're back up above the 2.5% mark above the 30-day moving average. Obviously, you can see that's a good level to be at. That's a nice sustaining bullish trending level. The intermediate line is back above the 90th percentile. So again, very strong bullish trend. Market sentiment line's rising. It's almost to the 75th percentile. So it's definitely working its way up towards the upper reversal zone itself. And obviously the intermediate line still above market sentiment. The near-term line jumped today. So it took more than just 2 days. We were anticipating a bullish bounce off of this, and you know, we were Monday's drop was a little concerning there, but again, we kind of expected that we would continue this bounce, and we did. A nice, good near-term rally up to the upside, and it's a very strong level, so a good chance that we can maintain. You see, when it gets above 90, doesn't always has to, but it's a good chance it can maintain a good near-term run for a few days. So that's a good opportunity right now we're getting. That's only on the S&P. The Nasdaq 100. You can see it also has a strong near-term line. The intermediate line is not as high. There it's still barely getting back up above the 80th percentile itself. It's still above market sentiment. The near-term line, you can see the momentum line, fell, but not very much. So that's also a very good sign. Your Dow Jones Industrial Average, which did not go up as much, it ultimately did go up as much. Its near-term line did not go up as much. The momentum line is there, but remember this is day one, because this one, the near-term line was below 40 yesterday. None of the other two were. So it did jump. This is day one of it being up above 40. So day two, you need to get above 80 so we can have a bullish near-term line, especially if we can get above 90 like the other two. And the momentum line is above 80, so there's a good chance that can happen. So that's looking really good. You can see the highest close, an all-time high close on the Dow Jones Industrial Average. The Russell 2000 is a little different, right? It still is very sideways. So you're back to dark green shading. The intermediate line has risen, but you still have a yellow line. The moving average is actually still falling or above it, but you're still falling. That's why it's yellow. The intermediate line is still above the market sentiment line, so that's a good sign. The near-term line did not get into bearish territory yesterday like the Dow Jones, and has not bounced up either into bullish territory like the others. So it's still very neutral. Market sentiment's neutral. It's pretty much flat. It says it's rising, but you can see it's pretty much flat right on the chart's midpoint. The intermediate line is pretty much flat. These two short-term sentiment lines are right near the midpoints. So it's a very neutral pattern that we're seeing on the small cap index. So again, and the near-term line's not. Like, remember how we got above the intermediate line a couple of days ago, but we expected it wouldn't last, right? We wouldn't stay up above there. And it did not get above 80 to produce a bullish peak, and it fell back. So the near-term line is still below the intermediate line, and that's an important relationship with the lines, with the intermediate line still between the reversal zones. So any crossover to the upside and the downside when it's between the reversal zones is either a bearish or a bullish crossover. So we're still in that kind of bearish crossover mode. We didn't have that problem with the other indexes because their intermediate lines are already above 80. That is an issue with the Russell 2000 with it not being above 80. So it is bullish, but it's not as strong. It's like you can see how, again, the S&P is forming a new high, the Dow's forming a new high, the Nasdaq's getting there. The Russell still isn't, and still is kind of, still like you got that long upper shadow from over here at the end of July. You got this long upper shadow from the day of the rate cuts, and that's still holding for resistance levels, and we're not able so far to get above either one of them. And again, this bull tag, we are above the high of the bull tag, but we haven't really built off that bull tag and really taken off. And so we're still lacking that kind of, that nice, good thrust to the upside on the Russell that can, that get the near-term line up above 90, at least above 80, but ideally above 90, and it can really get us going, for a longer period of time. And we haven't had that. So not necessarily getting that broadening trade that was so widely publicized here, and when the markets are rallying, it's still rallying, as you'll see here later, by with that technology sector leading the way higher. All right, now let's take a look at the weekly chart. So let's come over here and look at the weekly chart. Remember, we have another bullish candle. It's not a very big bullish candle, so the size of the candle down here is still below its average. But at least the PPO is still rising. It's still relatively high as well. And we are getting a higher close again. So that's all a good sign. A higher high, a higher close, all very, very good from that perspective, rising PPO. Obviously, we have green arrows again. We don't quite have that green arrow yet on the MACD on either the Dow or the S&P. We do on the Nasdaq 100. So we do have 3 green arrows there. This green arrow occurred over here, and then these other 2. And then the Russell 2000, we only have the 2 greens, but the stochastics is barely turned up, and we don't have that MACD turning higher either. So we're still in convergence mode, where we are still, in this case, still below the moving average, but we've already peaked on the MACD histogram. We've already come off the low. We've already peaked on the histogram. We've already peaked on the MACD. So any moves up above the moving average, you would not expect it would be something like this, where it'll just be kind of a slow grind to the upside. There's a little difference between right now and what we saw over here in the early part of 2024. I'll show you here in just a little bit. But again, we're not looking for a big move to the upside, but we like these small grinding moves. It definitely was, a very small move. We're still not trending. Like the DMI is not showing a trending pattern yet. We're not back up above 24. I was looking in our technical analysis class today. We've never had the negative indicator of the DMI be so low without the positive indicator at least being above 25, if not further, up above 30, and a lot of times up closer to 40. So the fact that it's so low and we're still not even above 25, again, that's a rare combination that it's, again, goes to show that we're still very susceptible to weakness here, because again, of how low that negative indicator is and how easy it will be for it to bounce and cross above the positive. Whereas that's not the case if the positive is so high and so far away. which usually means that the ADX is so high. See, the ADX is barely above 20, and it's usually much higher than that. If you take a look at the RSI and the CCI, you can see they are at pretty strong levels, above 60 on the RSI, well above 150 on the CCI. So that's the first time on the last two bullish runs, but the first time on this current intermediate rally that we've gotten above 150. We've seen that kind of before, where it's taken either, if you don't get it right at the start, it happens a lot later, and can happen towards the end of an intermediate run. So this is something it happened at the end there. It happened at the end of this one. So we do need to kind of pay very close attention to, just in case, we might be getting a spike higher here, again, maybe towards the end of this intermediate run that we've been on really since, for over 2 months now. Even with that little small pullback, of course, that produced that bull tag, but did not end the run. If you look at the Ichimoku cloud, you can see again we're still above the cloud. We still have a pretty good intermediate strength trend. We have not passed the mature threshold yet, which can really solidify a trend for a while. But we're at least we're moving in that direction. It has to get above 80. We're almost there. It has to get above 5. We got a little bit more work to do. We obviously have a very strong positive rate of change that is just going to get stronger because the 26-day mark is going to get the first day is moving lower here, and unless we move lower too, we're going to get a really decent rate of change bump on that. And then finally, looking at your Bollinger Bands, we are back. In fact, we closed up above the upper band today, barely, but we closed above the upper band. The band width is really small. It's actually come way down relative to the 150-day range. It's that very, very low bandwidth, which doesn't really jive. Like this, again, we saw, again, both the directional index indicators are a week ago were both below 20. They're both below 25, which is, again, rare for the positive to be so low when the negative is so low. Now we're seeing the bandwidth is also very, very low, relatively speaking, to its last 150-day range. In fact, it's one of its lowest levels that we've seen for the year. There's been a few other times where it's been a little bit lower. That sparked a new bullish run there. It sparked a bearish move there, and it sparked a new bullish run there. So in this case, obviously, you would hope it would spark a bullish move because we've already closed up above the upper band, and we're close to the upper Keltner channel. The bands themselves are still inside the Keltner channel. The momentum is already high, so it's not like we're going to start a new bullish move. Like you see when the momentum, even when you get the red dots and we stay bullish, like we've had a couple. Again, this is pretty rare to get these, but we've already had 3 actually this year, and so we potentially could get a fourth on the same run. But this would be the highest level that we've had. The red dots, see all these other red dots occurred when the momentum had fallen a lot lower than where we're at right now. So you would not expect a new run to start from an already elevated level, already being above 1,000 here on this particular indicator. If you take a look at the weekly range, we did get a new 4-week high point today, so that's a good sign. We got back up to 100 here, but this is not a good sign. Like, we've really dropped. The price width channel has dropped down. It's going to drop again tomorrow. We're going to get another big move up here tomorrow. We still have this common gap that we haven't filled in from yesterday. So that's you would assume that we'll fill that in sooner rather than later, which means now it'll take actually a bigger move to the downside to fill it in, and which would move us further away from that high point and actually get us closer to where the 4-week low point will be by the end of the week, which will be a little bit above the current chart midpoint. See, that chart midpoint's also going to move up, kind of up into this range, basically to where that gap will be by the end of the week. So, it's a great move to the upside, a new high, but it wasn't a far enough move to offset the big move up in the low, and so you had a big drop here, and that's just going to drop even more tomorrow and a little bit more on Friday, barring any new highs we get and how big those new highs are. Obviously, the range and the volumes are very, very low. Oops, wrong chart. When you look at those indicators, you can see below average on both the range which is actually not a bad thing. If we want the markets to stay bullish, we want those ranges to move. But you can see, again, we are very low. We're very low across so many. We're not below 1 yet. We're not extremely low, but we're well off the peak of where we were. But yet, when you look at the volatility index, it is not well off its peak. In fact, it's pretty close to its peak from where we were a little bit ago, when we had peaked up here, up above 22 here in early September. We're still around 100%, just a little bit below, kind of right on it actually. Right there, just a little smidgen below. And here's the scary thing is not only is the VIX still above 20, the VVIX is still easily above 110. The VIX itself is still elevated relative to its moving averages, still up above, which are all rising. So VIX is still elevated. We haven't had, even though the ATR is low, the Bollinger Bandwidth is low, the DMI, all these other indicators that look at market volatility are all really, really low. The VIX and the VVIX, and for that matter, as I'll show you here later, the skew are all really high. The skew, just to kind of, again, just a quick reminder here, is a measure of market of the demand for way out of the money put. So yesterday is at 155. Today it's at 156, so still at very elevated levels. In fact, the average here is almost at its all-time high, the 20-day average of the skew. And so before the VIX can drop, the skew has to drop, right? The skew usually can't drop, unless the VIX is already, unless the VIX is rising. So with the VIX so elevated, it makes me like, at some point in time, this VIX is going to drop pretty big, right? I don't know if it's going to be after the CPI or after we get some earnings, but we should get a big drop in the VIX here, back below towards 15, back below the 90% mark here relative to the VIX 3M. This dropping well below 100, if not down to the back below 90, so we can get back into bullish territory here. So at some point in time, the volatility is going to come out of the market. But it can't come out until it comes out of the skew first. And the skew doesn't drop unless you have a drop in the actual market itself. That's what makes the skew drop, is when the market itself is on a decline, especially, again, considering how elevated it is. So you can see even that little 5% pullback got it to drop enough to get that last leg higher, and then it really started to drop during the correction. So, again, it doesn't have to be a big drop, but that's what's needed for the VIX. The VIX follows the skew. Skew drops first, the VIX drops next. The VIX is already really elevated, which you would normally get when the skew is low, but that's not the case. So you have low, even though the VIX is high, all the other market volatility indicators are all pretty darn low with a high skew. That would suggest that the VIX may not be done going higher in the relatively short term. As I mentioned, we have that gap to fill from a couple of days ago. So we, nice, good bullish move, and an opportunity that we can continue to be bullish, but we do have to be aware and be wary and be on watch for that type of jump in volatility that can literally come out of nowhere, because we are more susceptible to that now than we have been for a while. All right, now let's take a look at what's driving this price action. As you can see here, excuse me, what's the 3-month period, you can see is really starting to consolidate after, kind of being a risk-off type move, and the Qs were, big underperformers there for a period. Now things are kind of changing around. If you take a look at just what happened here today, you can see the Qs continue to lead. They're the big winners today. The dollar is actually up quite a bit today. Yields are up quite a bit today, but that the third head of that three-headed monster, commodities, are down. Now the commodities are way off their lows, about 1 full percentage point off their lows. So it's actually, you could argue that it's had the best, from this period of time, it's probably had the biggest gains on the day today, and yields continuing to fall from that point, and dollar rising slightly from that point. But from the open, for at least from yesterday's close, it's a big drop. If I were to zoom out again, these are the last 3 days that, like Nvidia had those strong, had a good day here, had another good day. The Qs and the S&P are still the only, equity asset classes that are doing good. The small cap stocks are down for this week so far. Emerging markets still getting hammered with the China news, with the potentially lack of stimulus that's going to be put on there, and that's why commodities are down. as much as they are. Gold is down along with commodities, and the strength in the dollar also putting some pressure on gold. And you can see again, yields are up, the dollar is up. So again, 2/3 of your three-headed monster of risk aversion are impacted there. If we take a look at the yields, you can see still doing a very, very good move here. The 8 and 17 are, the MACD is very strong. The histogram is still pretty strong. So it's not gonna, you're gonna roll over. The MACD is gonna peak here at some point and roll over here, though it's in the 92nd percentile, and you can see it can go higher. You can see it's gone a little bit higher previously, and the histogram, which actually now is down just a slight little bit, has also been slightly higher, as you see back over there now. Over here is actually above the 200-day moving averages when you had those two big moves, and even this one here is also above the 200. Here you're coming from being below, well below the 200-day moving average with that little bullish divergence that you see. A very strong stochastics indicator as well, and you can see the average can get higher and stay elevated for a while. So it doesn't have to drop tomorrow. It can stay elevated here. But again, as I've said before, it's going to be capped by where the Fed funds futures are expected to be by the end of this year. We're expected to get two more cuts by the end of this year. After that, I think next year, there's still pretty decent probabilities for cuts next year. But I think they have been coming off the table at a very rapid pace. I think they will continue to come off the table at a rapid pace. Not necessarily the yields might not rise, but what might keep rising, even if yields doesn't, is that dollar. That dollar had a big move higher today. Is looking very similar to the 10-year yield in that it jumped up, is getting closer to its 200-day. It will not be capped by its 200-day moving average. So it can really get going here. In fact, this, as we saw, when you look at the rate of change for the dollar index over the last 8 days since we've had this little rally here. That's an 8-day rally that we've had. It is one of our stronger 8-day returns for the dollar. It's the strongest we've had in this past year, but you have to go back to 2022 to have the kind of rallies we've had in the dollar, and those again were all kind of correction levels. Now we also had one at the beginning of 2021 when inflation really started to pick up in the early part of 2021. We had a kind of very similar pattern where yields and the dollar both really rallied there, and if you look at commodity prices during this run, again we had a pretty decent move at the right at the very beginning here. Again, similar to the type of runs that we had in early 2021 as well, going into that late February timeframe. So now commodities did pull back. So that's that third head of that monster, of that risk aversion monster here. We did pull back. We held at the 17-day moving average and the 200-day for that matter. Of course, its MACD and histogram are both falling. So that would be expected, right? That's kind of expected to see there. But you have a decline in the commodities, but I don't know necessarily how much more it will decline. Yes, we're not as parabolic as we were. That's a pretty decent parabolic move for commodities if you look at it. Very, very parabolic move to get that positive indicator. And now the ADX didn't get there, but the positive indicator got up to a pretty decent level. Again, didn't stay up long enough for the ADX to get there, and the negative didn't stay down long enough. It's already back above 25, that negative indicator is. But the positive is not down below 20. So again, you have both lines up above 25 here, which is not very common. Which means, in my opinion, that negative indicator is going to drop back down. Which means I assume that we'll get another bounce back up here in commodities and continue this trend that is on. Particular of interest would be, of course, watching the crude oil, which is producing a big long lower shadow after a big kind of an engulfing pattern yesterday. We had a big drop today too, but got a long lower shadow. The DMI still looks pretty positive, so I don't know necessarily that we're out of the woods yet on commodities. So I wouldn't dismiss that third head because of some of the weakness it's had over the past couple of days here. The breadth still looks very poor. If you take a look at like the McClellan oscillator, it's still down below that minus 35 level, that important level. See where it ends up by the end of the day. Money flow has been dropping like a rock too, is out of bullish territory, almost into the lower half of the chart. We start looking for signs of weakness there. So the breadth and things like these are not not looking very good. If you look at some of these other oscillators or other indicators that we look at that measure breadth, the number of new highs is not at 211. It is actually still relatively low. It's at 150. So when you look at the, where 150 is, it's still like down here. So it's a jump from where it was, but not a jump past where we were last week on the 4th when we hit up to 169. Now the day's not over. We can accumulate past that 150 or even past the 170 mark, but we're definitely not that giant. And we're still below the average, right? Generally, there's weakness in the markets when we're at least in convergence mode when we're below that average there. So we're still getting weakness there. When you look at the number of stocks above the 50-day moving average, we're still below that average, and that average is up above 380, a pretty high level. We're still below that average. That's a sign of weakness. And the number of stocks above the 200-day is also below. And they're both up. They're only up a little bit, and they're still both below their averages. And if you look at the ratio chart here, we are above the 1 level, and we're above its average. And starting the cycle higher, which again is traditionally associated with risk aversion. So the breadth is looking very poor. We had very, very extreme breadth. When we were at this peak right here, everything was extreme. The number of stocks above the 50 was at an extreme. The number of stocks above the 200 was above the extreme. The number of new highs we were getting was up to an extreme. Everything was up to an extreme. And we've had look at the McClellan Summation Index. It was at the highest level since early 2019. It was at an extreme. So all these oscillators were at, you saw the money flow, all the oscillators themselves were at an extreme when we were at that peak. And now we're still rising, but we're just losing breadth really, really rapidly. And so it's not the best, that's not the kind of breadth, it's not the kind of moves that you would associate with good broadening trade or a good rally up to the upside. We're still kind of getting, if you look at the QQQ ratio relative to IWM, it's not up, it wasn't up today. Now it's up a little bit more here, QQQ relative to IWM. We're back up. You can see the correlation is moving up pretty rapidly as well with the equity market, and we're starting to turn up higher here. This is already pretty high. The DMI is already pretty high. We've been up above 30 before. Right there, we had a pretty good run. We also had a pretty good run on the RSI. The RSI is slightly above 60. So what we need to see is a breakout. Even though it's already so elevated, we need to see a breakout above this what is it, 224 level. We've gotten above 224, and you can see, following my cursor to the left, there's been a few instances of getting above 224 that have failed. There's obviously been that one instance right there where the markets were, in May and June, where we really took off, and it was led higher by, the Mag 7 stocks, and everything was great. But all the other instances, we failed to get above 2.24, even including here recently a couple of times. And let's see if we can hold it this time and really get going and get this long-term PPO rolling back up to the upside, because that is our best bet of us maintaining bullishness. Of course, the other aspect of that is technology continuing to lead. That's a nice, good move higher there. Let's get this back to SPY and pull this back to SPY. So even though if it's not led by NVIDIA, but we're still, look at that move higher. They're still in the leading categories. XOK and XLC are still got the highest momentum outside of energy than all the other sectors. You got your safety trades over here on the left. Discretionary is not looking good, but at least the other two are. And if you look at the weekly, they're getting strong enough that it's starting to make some inroads on the weekly indicators. You can see technology is really gaining some momentum in the past few weeks, and all these safety trades have been losing momentum on the weekly basis over the last so many weeks here. So now whether they will continue or not, remains to be seen. We need to make sure that we get a continuation of XLK outpacing SPY and break up above that 200-day moving average and really turn this around. You're starting to see signs of that, but we're not there yet. And like I said, we can't have another failure like we've had here these last couple of instances where the QQQ jumped up above. Here's that ratio chart that I mentioned. If I look at the ratio chart here on the sector comparison. You're looking at, again, just at the beginning of this week, right? Here is a 5-minute chart. So the past 3 days, XLK is clearly the big winner. Industrials and healthcare, interestingly enough, these three do not necessarily go hand in hand. A lot of these other sectors are flat, if not down. So they're not only underperforming the markets, but they're actually down for the last, and especially utilities, which is actually not a bad sign considering. But it's safe to, this interest rate sensitive area and just how bullish it was, it would not be a bad thing for XLU to really start underperforming the markets here for a while. It was so bullish, right? Look at that big break below the 50-day now, potentially going down to below the 200, which is, it had been slightly negatively correlated. We'll see if that turns back to it's slightly positive now. See if it turns back into a negative correlation. But this is the one that we don't want to see improving, and it has been, and that's energy, right? Breaking up above. This is negatively correlated. We want it to stay down, and that doesn't have to go down, but at least stay down, not go up. And so we want to see that relationship start to slow down again, go back towards, this is the one that we want to continue to move higher and lead us higher. And that brings us to our trade idea of the day. Let's take a look at Archer Daniels Midland. I was actually kind of in more of this material space, but you can see has been bearish for most of the year. Tried to recover from earlier when it really crashed down from 60 down to the low 50s. It's been bullish until peaking with this overbought cluster, and then now has been moving lower and now has a new oversold cluster, similar to what we saw over here, down 5% below the moving average. If you take a look at the weekly chart, you can see that's where it kind of looked a little different. We may be just starting a new roll over to the downside as we head into earnings with a bigger bearish candle here. The PPO starting to roll over. Obviously, you have 3 red arrows on the chart. If you take a look at the 2-line version of that, you can see the 8 and 17 day are moving down away from the 30. They're all below and falling. They're all falling. The 30 is almost back below the 50. They're all below the 200. Below the point of control, the MACD and stochastics are at bearish levels. Looking at some of these other oscillators, you can see they're also showing bearish signs above 30 on the negative indicator, below 20 on the positive. And the ADX is just starting to rise down there from being below 20. If you look at the RSI and the CCI, you can see they're also showing bearish patterns, below 40 on the RSI, below minus 150 on the CCI. Looking at the Ichimoku cloud, we are obviously below the cloud. The rate of change is negative. We don't even have a bearish trend started yet. It's not even a weak trend. So again, kind of showing that we may be just kind of starting a bearish move to the downside. We are in the lowest bandwidth, have been for a few days. The bandwidth is rising. We're now, more so today than the last few days, we are now into really close to the Keltner channel. The bands themselves have closed outside the Keltner channels for the first day, the green dot, with some bearish momentum starting to rise there. So it looks like we may just be getting going on a downside move. So what I decided to do here is to do a long put vertical spread. Again, we put this trade on already before the market closed. So I'm going to sell the 55 to low 30s delta because of how bearish it already is. With the cluster especially, I'm going to only go to the 30 delta, kind of mid low 30s delta. Sell the 55, buy the 57.5. Position size for our typical $500 of risk on a directional trade. Getting a little bit more than a 1-to-1 reward to risk ratio. Again, a higher probability directional trade. I'm going to give up some return for the probability. A lot of flexibility on this in case it doesn't work out immediately. Again, considering how bearish it already is today. We can give it some time to kind of meander around a little bit. And again, this is about, twice as what your typical bear call spread reward would be for about half the risk. So it works out pretty nicely from that perspective. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Remember to subscribe. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.